So if, let's say, for example, you're single and you're not yet married, if you can't save 60% of your income, you can't afford a spouse.
Wow.
I wanted to get married!
Yes, I think about myself.
So
现在市场价值到底是多少？
Welcome to Real Estate Real Advice, Ohmyhome's very first podcast. Come join us every month as we speak to an expert in their field talking about all things property. I'm your host, Audrey, and today we'll be talking about affordability and budgeting and how to make sure you can actually afford your home. And we have a very special guest today. We're joined by Hariz Maloy. Hi, Hariz.
hi, Audrey. Nice to be here.
Now, Hariz was an independent financial advisor for many years. He actually now works at our digital marketing team. Well, he leads our digital marketing efforts here at Ohmyhome. But before, he has actually helped hundreds of families and taught them how to optimize their CPF. He actually told me earlier today that talking about CPF is actually his favorite thing to talk about. So is he not the best person to have on today?
Thank you.
Tell us a little bit more about yourself, Hariz.
Yeah, Audrey, I think you are spot on. So right now I am the digital marketing manager here at Ohmyhome, joined about 5 months ago. But for 5 years and 3 months before this, I was an independent financial advisor at Promised Land. I've served over 400 different families on CPF matters, giving them guaranteed income for life. I've co-written a book and I've been writing one for a while now. But we can talk about that at a different time. But yes, talking about CPF is one of my favorite things because it's just it's a third of your income, right? It's a third of all the money you make as a Singaporean. So it's pretty important to understand it and know what you can and cannot do with it. So yeah, it's thank you for having me, and I'm hopefully we'll be able to give good advice to our listeners at home on what you can do with the CPF and also how to plan around property and buying a house.
Absolutely, it's very important, and I think affordability has come to the forefront in Singapore when it comes to property. Of course, rising interest rates with inflation, it has actually become very difficult for young Singaporeans, especially when it comes to owning a home. But before we launch into that, I want to kick off our podcast with our very first segment, which is story time.
Okay.
So if you're able to tell us a story, Hariz, about maybe the most interesting story, the most memorable client that you had before. Of course, the topic is budgeting today. So if you're able to share with us a story about budgeting and how you have helped this family.
So I remember this slightly elderly couple. They were in their early to mid 50s.
Ooh,
right?
You're going to offend my parents. Elderly couple.
Slightly, and they're getting into the golden age of retirement. And it is the time where you make pretty much your last big financial decision with your property, which is, should I continue to stay in this house? Should I right size, sell it, move to a smaller place, right? So this couple, as with many couples, bought a property more than they could afford, when they were a little bit younger. And yes, they had kids, but now they're at the age where the kids are already grown up and they've already moved out. So this place was getting a little bit too big for just the two of them, right? And because they bought a property, it's a little bit, again, like I mentioned, a bit too much for them at the time. What happened was that close to 80% of their entire net worth was stuck in that house.
Well, they're sitting on all that money now.
Exactly, right? So they're staying in a kind of like an executive flat, right? At that time, it was worth probably $850,000, right? And they wanted to retire pretty much soon, right? They wanted to stop work, and they wanted to take that money out, right?
Amen.
So, perfect, right? So it was pretty simple. All they had to do was right size. They just realized, what, we can cash out right now. So just for the two of them, they moved to a 3-room flat. They paid off the remaining mortgage, which wasn't much at the time because they've been staying there for pretty much 15 years or so, right? And they got, I think, close to $500,000 of cash and CPF. They maxed out their full retirement sum. In fact, they could go to the enhanced retirement sum, which gave them a little bit more guaranteed income for life. And still with cash, they could give them another $2,000 per month, pretty much for the rest of their life, for the two of them, right?
Wow.
So it was a good thing. It wasn't that difficult, but seeing them move out of their, the family house was quite emotional for them. But understanding that, it's time to, make sure that the space fits them well and plan for the next 20, 30 years of their life, maybe even longer, hopefully. All right, so they're still good friends of mine, and they've already moved into their new flat, and it's a lot more comfortable, and you don't have to worry about maintenance, because what happens is that assets in old age do become a little bit of liabilities, later on, especially because you still have probably a little bit of mortgage left. You still have your maintenance, you still have your repair works and all that. It's not giving you income, right? But what you want at old age is income, right? So selling it and turning that cash into income for months and months, to the point where they can travel every month if they really want to.
Wow.
Was something that worked for them, and that's what we did.
That's fantastic.
Yeah.
And how long ago was this? Do you remember?
This was about 2 years ago. So just actually now thinking about it, it's more than 2 years ago, almost 3 years ago, because it was just before COVID. I believe this was at best late 2019, early 2020.
I see.
Yeah.
Well, if you next time you speak to them, tell them that Ohmyhome says hey.
Yeah, of course.
Yeah,
definitely.
I would love to talk about the go into our next segment, because you mentioned outstanding mortgages, and that's something that I want to talk about as well.
Sure.
Our next segment of the podcast is called Top News of the Month, and what we do is that we focus on news topics and headlines that have really garnered a lot of reaction from Singaporeans.
Okay.
Of course, it's targeting property, and we're targeting financial news today.
Sure.
So rising interest rates, inflation, all of these topics really have come to the forefront just recently this month. And I actually have a piece of paper for you.
Okay.
I'm going to get it for you. So here are the topics that I want to talk about today.
Yeah.
What I did was that I go on Reddit, I look at the threads and what people are talking about. I love reading the comments on Reddit. They are so unabashedly.
During office hours?
It's part of work.
Okay.
But I love seeing, the honest feedback of Singaporeans. There's nothing quite as unforgiving as what people have to say about property nowadays. And I wanted to talk about this most recent thread, what this writer Alvin Tan, posted by Microtech Analysis.
Sure.
He posted 1 in 3 homeowners with outstanding mortgages affected by rising interest rates.
Yeah.
And he posted a Straits Times article that goes with that. Of course, now we know that interest rates are really high. We're talking about 4.2% to 4.5% for bank loans. What is your take on this and this number, 1 in 3 homeowners being affected by these interest rates? I would think that it's actually higher than that,
Yeah, I mean, this is what we understand with the term mortgage stress, right?
Yes.
Your mortgage, especially when you can understand that a lot of people bought these houses 2 years, maybe 3 years ago, when interest rates weren't as high, right?
Absolutely.
So a lot of the times when people plan budgets around the house that you want to buy, they're usually pushed to buying the biggest that they can afford, right? So if for example, let's say for private property, there's this thing called TDSR, which is the total debt service ratio, right? Before the recent change, it was actually up to 60% of your income, right? So if let's say you can max out 60%, right? A lot of people would, because that means you're getting the biggest loan, which means you're getting the biggest house. Right?
Is that prudent?
Of course not, right? And we can talk about that a little bit later, but that's usually what happens, People buy homes bigger than they can afford, right? Because there is a love for property. It's almost like a religion here in Singapore and in most of Asia, all right? So it's understandable that they maxed out the TDSR, so anything above that, even if interest rates just went up 0.1%, it's going to be unaffordable already, because they've already maxed it out 2 years ago.
Yeah, but
right?
imagine, like earlier this year it was 1.5%, and now at 4.2%.
Yeah, so you're paying pretty much 40 to 50% more.
Wow.
Per month. So if you're already paying 60, 50% more now becomes 90%
Wow.
of your income. Everything you earn will be paid to your mortgage interest. Yeah, so that can be quite ridiculous. But even those that were slightly more prudent and maybe were only paying 40% of their income now pay 60% because interest rates have risen. You pay 50% more.
Yeah.
You know, so it's definitely getting unaffordable for those with existing mortgages. You know, for those that have probably stayed in their house for 10, 15 years, they take in a 25, 30-year tenure. You know, when they bought the house, they aren't as affected.
Okay.
You know, so maybe the 1 in 3 is quite accurate because that would mainly be the people with quite new mortgages that probably bought a house 2, 3, maybe at best 5 years ago.
Okay.
Right. And these are the guys who, you know, most likely haven't had a significant increase in income either. You know, so if you bought a house 10, 15 years ago, 10, 15 years later, you probably make a little bit more money. So the interest rate going up, paying a little bit more mortgage could be an okay thing to kind of react around. But if your income hasn't increased at the same rate as our interest rates have increased, which I doubt it has,
Right.
then yes, this is where people will fall into mortgage stress. And this all comes from buying a property too big, much more than they can afford when they make that property purchase, you know, 2, 3, 4, 5 years ago.
Let's definitely talk about how people can buy homes that they can afford.
Yeah.
But before that, I do want to talk about more comments on Reddit. And this person, Financial Learner 123, said, you know, these people have enjoyed lower interest rates for a certain period if they didn't take HDB loan.
Correct.
I guess you can't have it both ways. So this comes into question for our listeners. Should they go for fixed rates versus floating rates? Should they go for bank loan versus HDB loan? Let's talk about fixed versus floating. Can you talk about the pros and cons of these two and what you would recommend?
Okay, I would say it isn't too big of a choice, right? With fixed rates, you get dependability, right? You know how much you're going to pay for at least the next 2 to 3 years, because most fixed rates are locked for 2 to 3 years, right? So you don't have to really think about it. You don't have to worry what the Federal Reserve is doing. So it's simple, right? I'm borrowing this much, 4.5% of that. You know, I'm paying $2,500 a month.
It's
That's
easier
not
to
gonna
plan
change.
when you know that
Exactly,
that's what you're
right?
going to
So
pay for.
if you've already budgeted that amount, if you're comfortable with that amount, then yeah, you can take fixed rate, no issues, right? Now, with floating rates, that's the bet, right? You're taking a punt. Will it go down? Will it go up? You don't know. Most of the time, floating rates will always be cheaper than current fixed rates, right? So even if interest rates do increase in the future, you're already saving money today. For some people, that's already quite worth it, right? And so I would also want to talk a little bit more about when it comes to floating rates. Today, we are pegged against SORA, which is the Singapore overnight rate average, right? Before this was SIBOR, which is the Singapore interbank offer rate. Okay. The difference is that SORA today is a lot more transparent.
Okay.
Right? SIBOR was definitely only between the banks and the rates. I'm not saying the banks do this, but they could collude to kind of like raise the rates, right? So because we're pegged to SORA today, a lot more transparent, it's actually not a bad thing to be taking a floating rate, because you can check it on a daily basis, right? You don't have to wait for your bank, oh, new SIBOR rate is this much, and you pay up, you know? So because of that transparency, it's definitely a little bit better.
Okay.
Yeah, so if you want to take that punt, and you already see that, okay, I'm saving money today anyway, then sure, you can definitely take a floating rate. And I believe floating rate has to, SORA has to increase by another 0.75% to be higher than current fixed rates.
Okay.
So even if it goes up to above 0.5, that still only matches with the current fixed rate. So there's still a little bit of leeway there. Yeah.
I'm going to need some time to process all of this afterwards.
I'll send you some links.
Perfect. And just to wrap up this segment of Top Property News, I do want to focus on another article that I thought was really interesting. We actually pegged our property recap yesterday on this article. It's from Asia One, and the title is More Young Singaporeans Find Current Property Prices Too High. Now, I don't think this is specific to young Singaporeans. It has skyrocketed the last couple of years, but more young Singaporeans compared to older age groups are now renting because they find property prices too high. A lot of them peg this to a lack of savings. They haven't saved enough to buy. So Singapore, we do boast very high ownership rates. We're talking about like 90% of our population owning property. But 66% of young Singaporeans are now renting. Now, they say that they still intend to buy, but as of now, they just cannot wrap their heads around how much properties cost these days. What advice do you have to these young Singaporeans? Should they still intend to buy a home? And what do they do at a time like this?
You know, so I'm fortunate enough to consider myself part of young Singaporeans. I believe that survey was between 22 to 29. So
You don't have to flex,
so
Hariz.
I'm still 29, and you know what? I'm in the same camp. You know, so I myself feel it's property is a little bit too expensive, and I myself rent, right? And I mean, it's quite easy to understand why. You know, property prices have increased 20+% just from the start of this year for, you know, across the board, HDB and private property. And also for young Singaporeans between the age of 22 to 29, these are people who most likely just graduated from school or maybe still studying, you know, and those who just graduated maybe have only worked 1, 2, 3 years at best, right? So because majority of people graduate from university 24 to 26 years old, it's around the average, especially for guys. So yeah, it's understandable that they don't have that much cash savings today. You know? Even if they've been working for a while, you know, it takes a while for your ordinary account to kind of, you know, accumulate so that you have enough for the down payment. Right. So a lot of people can understand. I mean, I can understand that there's still a need for space, so you want to rent first, right? But putting off, you know, a property purchase, just saying, "Oh, it's too expensive. I'm never going to own a house." You know, that's the wrong mindset to have. I mean, considerably, if you're comparing against other developed cities, right? Singapore's public housing is still kind of affordable. You know, you want to compare against New York, London, no way. You know, no way in heck is you know, those places cheaper than Singapore, especially for HDBs and with the BTO route. You are getting subsidized housing, right?
With grants and all that too.
Correct, right? So having the mindset it's too expensive, I can never afford it, what happens is that then you don't make concrete plans.
That's right. So I actually wanted to bring up this article by Channel News Asia. We also talked about this yesterday on Property Recap, but it basically focuses on how it has had such a trickle-down effect because you can't buy your property. More Singaporeans feel like, oh, now I can't get married, now I have to put off having kids. And like when milestones and timelines fall by the wayside, that could really have a long-term effect on your entire life.
No, these are dire consequences. You know, yes, property is the most important thing. When you have a roof over your head, you're more confident to make future plans. You have that safety, you have that safety net. I have a roof over my head. I can take a little bit of risk now, you know. So when you don't have that, you can't make future plans. And in Singapore, funny enough, it's all tied together, because if you want to buy a flat below the age of 35, you need to have, you know, spouse or fiance or family, right? So it's kind of like a chicken and an egg situation, right? Do I get the family first, then I get my house? You know, and especially for the kind of the new Gen Zs coming to that age range, right? So that 22, 24-ish age range, they're just entering the workforce. They're the group of individuals, unlike our parents, who definitely want to make sure they're making the right decision with the right person by their side. I would think that maybe my peers, maybe just a little bit older than me, when they're together with their partner for maybe 1 to 2 years, they could already apply for the BTO, right? Knowing that, yes, the BTO is only going to come 5 years later, right? I better apply now, you know? But with the kids today, the Gen Zs, they're going to put it off, right? And I can understand that. But again, when you put things off, don't just, you know, don't just chuck it into the graveyard. make sure that you have concrete plans to eventually be a homeowner, because that's what you want, and that's what Singapore is going to push and be able to try and make sure that you can have that, right? So, start deciding I need to save an extra $300 a month, $500 a month, so that in 2 to 3 years I can then put a down payment down for my house. If you don't have those plans, it will never happen. Then you'll be 30 or 35 and you still don't have a house, and then you're not going to be married, you're not going to have kids, and then your whole life would just go past you, So it's important to have at least these plans in place, so then in the future, when things get a little bit better and you make a little bit more money, you can then buy a house.
Fantastic. Okay, so our next segment, Hariz, I lovingly call it Audrey asks a dumb question and the guest answers. Okay. So since CPF is your absolute favorite thing,
yes,
I'm hoping that you could shed more light on CPF OA. Okay. So should I or should our listeners use their CPF OA to pay for their mortgage? So there's this whole thing about accrued interest, right, that I'm hoping that you can explain to our listeners as well. But in order to avoid this accrued interest, should people actually use their cash to pay for their mortgage, or should they use their CPF OA? Is this a dumb question, first of all?
It's quite a common question.
Okay.
I think accrued interest has gotten a pretty bad rep recently. Just to kind of explain this, when you use your CPF ordinary account to pay for your house, so either in the form of down payments or monthly mortgage, what happens is that the interest that you were supposed to earn from the government, so OA makes 2.5% interest. For the first 20,000, you get an additional 1%. For anything above 20,000, it's 2.5% today. So if the money is not there, you can't earn the interest, right? So if I have $100,000 and I wipe it to put a down payment for my house, I stop earning 2.5% on my $100,000. Somebody has to pay that. So the government says, you have to pay that, right? Now that sounds like a scary thing. Well, I use my own money, I have to pay interest on myself, But actually accrued interest is not a bad thing. Now, let me give you a scenario. So accrued interest, as I mentioned, right? So you put $100,000 down, you pay your monthly mortgage, that's going to keep climbing. If you sell your house, whatever proceeds you make from that sale, you'll have to pay your ordinary account first to satisfy the accrued interest. Only above that, if there's still some profit, then you can take as cash proceed. But if you never sell your house, your accrued interest becomes this separate account that you can, as in when, decide to pay back, right? And when you pay back your accrued interest, that money automatically goes to your ordinary account. When does this become useful? It becomes useful after the age of 55. Now, at the age of 55, hopefully you can follow me, a new account is created called the retirement account. Your retirement account will take money from your special account and your ordinary account to fulfill something we call the full retirement sum. Today, that sum is $196,000. 25, 30 years from now, it's going to be quite different.
Yes.
It should increase by 3% per year, right? But whatever the amount is in the future, if you have fulfilled it, you have satisfied the full retirement sum, any balance in your OA and your SA become fully liquid. So after the age of 55, and you've settled your full retirement sum, when you pay back your accrued interest, that money goes to your OA, earns guaranteed 2.5, and anytime you want it, you can take it out. Pretty much you can pay now yourself, within 3 minutes you'll get the money, right? So it becomes liquid. And at a time where you can't take risks anymore, you're 55 and or older, you don't want to try, putting money into, the stock market or anything like that. Or crypto, hopefully, right, to earn an interest. That is a way to have, kind of like this pool of money, or at least a resource that you can immediately get 2.5 interest, and just take that money out anytime. Well, I understand that many maybe CPF geeks out there that would correct me and say you have to take from your special account first.
First of all, I want to say that CPF geeks, I imagine it's a very small and specialized
You'll
group.
actually be surprised. There's an entire community of CPF geeks, right? Which is not a bad thing. It's a good thing,
we should have them on this podcast.
Yes, of course.
Intro.
Right. So as I was saying, right, so you have to take money from your special account first before you take money from your ordinary account. But if your ordinary account actually has quite a sum, you can take the interest out from OA before you take out the principal from SA first. It's now so technical,
Yeah.
but it's still money you can take out that is liquid in the future. So it's not a bad thing.
Okay.
Yeah.
Okay. So your recommendation is definitely use your CPF OA
Yes.
to pay for the mortgage.
A second thing here to talk about is definitely cash flow, right? We already know 20% of our income, our gross income, is paid to CPF, right?
If you're Singaporean or PR.
Yeah, Singaporean and PR, right? So if you're not going to use that money and you're then going to use cash, that's another 20-30% from your cash.
Yeah, that's like you never see half of your paycheck.
Exactly, right? So if you decide to use cash, half your money is pretty much gone. 20% to CPF you're not using,
Yeah.
and then 20-30% to pay for your mortgage. You're only left with half, right? So if to help with cash flow, using your CPF to pay a monthly mortgage is a good thing. And with cash, liquidity, cash is king, right? Cash flow is king, right? With that liquidity, you can do whatever you want. If you want to take risks, you can put that money to the stock market to hopefully get a higher return than 2.5. If you feel eventually, I don't want to, take too much risk, you can use that cash to put into your CPF SA account, and then 4%, which is immediately higher than CPF OA account, right? There's some limits there, but just having flexibility with cash flow is definitely more important than accruing interest from your CPF OA. Yeah, so definitely use CPF to pay. And also, there's a cap anyway. The maximum is, $6,000 of your income is subjected to CPF. So I don't have the math at the top of my head. It's only $1,200 to $1,300 per month. That is
If you make 6,000 or
yeah,
over.
correct. That is paid to your CPF anyway. So if your mortgage is already like $2,000, you have to use cash, right? But you can use all your CPF and then top up whatever balance in cash.
Okay, good to know. So that was the dumb question segment. It's
No,
not
it's
so
a pretty
bad,
good
right?
question, Yeah.
Okay. Our next segment for real estate, real advice is called Tips from Our Guests. So I know, Hariz, you've actually given us a lot of tips already. But I'm going to give you a scenario, okay?
Yeah.
And you're going to maybe help me and our listeners with maybe giving us tips on how to make sure that we can afford our home.
Sure.
So imagine someone is just planning to buy a house and they came to you. It's like, Hariz, I'm looking to buy a house. I want to make sure that I'm able to afford my house. What are the top tips that you have for someone like that? Any rules of thumb or guidelines that they should be aware of?
Yeah, no, absolutely. So, Audrey, there are two, I would say, the most popular rules of thumb when it comes to how much I should, or kind of like these are guidelines on how much property I can afford, right? So the first one is the 3-3-5 rule. Though I don't kind of agree with it, I have a variation of that. The 3-3-5 rule is basically 30% down payment for your house, 30% of your income is mortgage, and don't buy more than 5 times your combined annual income. Now, I changed that slightly. 20% as down payment is fine, which is what it is today for HDB loan. For private property, is 25%. So sticking with that is okay.
Yeah, because 30%, I imagine, to put that down for a house, that's pretty high.
Yeah, it's quite a bit of money. I mean, just a $500,000 house, it's $150,000. You know, that takes a bit of time to accrue that much money in your either cash or CPF, right? So 20% is fine, 25% if you're buying private property. You don't have to put more than that. 30% of your income is mortgage. That's a definite. You know, that's something I strongly believe in. And if you're not buying a house, you're renting, it's 30% to rent as well, at best, right? Now, I do extend the 5 years of combined income a little bit to 5 to 7 times combined income. So I'll give you a little bit of an example right now. So let's say I'm with my spouse, and together we make $100,000 per year, right? So firstly, I know I can, at best, the most expensive house I can purchase is $700,000.
So it's 7 times what you and your spouse make.
$100K, right?
Okay.
So if I'm buying a $700,000 house, I'm paying 20% as down payment. It's $140,000. Okay, I'm borrowing $560,000. Okay, CPF HDB loan, 2.6% of that. I don't have my calculator right now. Maybe you can do the math there.
Come on, you're a CPF geek. It
Should be
right
around
there.
22 to 25% of your income,
Okay.
right? That's $22,000 a year. So it's less than $2,000 a month.
Okay.
I think, right? So that would perfectly fall below 30% of your mortgage,
Right.
right? So as long as you stick to that, you're good,
Okay.
right? The moment you try to buy $800,000, $900,000, $1 million, so 8, 9, 10 times of a combined annual income, that's when your mortgage will be probably more than 30% of
That's
your
right.
income,
Okay.
right? Now this is for first-time home buyers. For second-time home buyers, these are people who have sold the previous property. Let's say they're sitting on $300,000 of cash right now. Should that $300,000 kind of like add on? So for example, I'm making still 100K. So I'm buying 700K, but I have 300K.
Right.
Does that mean I should buy $1 million house?
Yes.
No, right? So I don't agree. So if you have received some cash proceeds from a previous house, that is not excuse for you to then now over leverage, right? You should still stick with the status quo. That $300,000 instead should be put into other means, right? What happens is that if you put too much money into your next house, you're pretty much locking up 70, 80% of your net worth into one asset. What happens to diversification? You need to be diversified, right? So you need to, yes, own property, but then buy some stocks, own some funds, own some gold. Don't buy crypto. I'm against that, but you can have some cash, emergency savings, buy art, whiskey, whatever you want. Alternative assets, that hold value, that could be things that you can invest in. Don't put all your money into one thing. The roof over your head.
Just like
right?
that family in story time
Exactly.
that you mentioned.
Right?
Yeah.
So they were lucky because they could manage the interest payments. But if you do that today with interest rates as high as it is right now, you're going to be stuck because you can't sell one room away. You can't split your property in half. Okay, I just want to sell half my house.
Yeah.
You have to sell the whole thing. And that comes with agent fees, stamp duties for your next house, tax, whatever, right? So don't over leverage on your next house just because you receive some cash proceeds from your previous house. Yeah, so that would be my advice. So 7 times combined annual income, make sure 30% of your mortgage is paid, 30% of your income at max paid as mortgage or rent.
Okay. Yeah. There was another rule that you mentioned, 40, 30, 20, 10.
Yes, correct. So you've been listening to me, right?
I
so
have been listening to you.
I have another rule, right? So the 40, 30, 20, 10, it's kind of just an add-on to that. So 40% of your income is expenses, 30% is mortgage or rent, 20% to savings, which is a must, 10% to insurance at max, right? So the only thing there is that 20% to savings, right? That's the minimum. Everything else is maximum. So for example, if I only spend 5% on insurance, right? Does it mean that I can now spend 45% on expenses?
Yes.
No, 5% goes to savings, right? So if you're spending only 5% on insurance, you save 25%. If your mortgage is only 25%, does it mean I can spend 45% on expenses?
Yes.
No, go straight to savings as well. So anywhere you save on expenses, mortgage or rent and insurance goes to savings.
Goes to savings.
Yes.
Okay.
So that is my rule. I have one more rule. This is quite harsh.
So many rules, Hariz.
Yeah, I know. I can be quite strict with my clients. The last rule I have is actually for those that are really, really starting out, right? So if, let's say, for example, you're single and you're not yet married, if you can't save 60% of your income, you can't afford a spouse. Because your spouse is going to cost you at least 20%. And when you're married and you don't have children yet, and you can't save 40% of your income, as the two of you, you can't afford children. Because your children are going to cost you 20%.
I can tell you firsthand that children cost way more than 20%
That's
of money.
true, right? Hopefully you make a little bit more money as well in the future, right? But as a married couple with kids, if you can't afford to save 20% of your income, you can never afford to retire. Your kids will be your retirement
I
plan.
need to retire, guys.
You don't want to be working here and doing this with me when I'm like 55, right?
You know what? I
So-
wouldn't mind.
Well, hopefully we'll have more things to talk about by then. But yeah, so that's the last rule. So that can be quite strict, but if you stick to that, your life will be fine. You'll be more than happy. You'll reach financial independence and security pretty early.
Will my life be fine, Hariz?
We can work on this. We can definitely work on this.
I also want to say that if you're a CPF geek now, can you imagine like 30 years from now, we will only be talking about CPF.
Well, why not? 30 years from now, hopefully I'll be collecting my CPF. You know, unless I leave Singapore. But yeah, so I think, you know, one thing I quite strongly believe in is that if you don't have control of your money has control over you. And then your money decides what you do. And most of the time, you're going to be doing things you don't want to do. Right? So when you have control of your money, then you can decide to do things you want to do. Right? Because money ain't your biatch. Yeah. All right? So that's definitely something very, very important to always have in your head.
Money ain't your biatch.
Yes,
I'm going to
correct.
remember that forever.
Yeah.
Okay. I know that we've like probably gone so over time,
Yeah.
but I do want to talk about our final segment of Real Estate Real Advice, which is let's review our top content of the month.
Okay.
So you know this content, Hariz, because you actually wrote it. We put out this article while you wrote it. It's called Sell One HDB, Buy Two Condo.
Yeah.
It was the strategy that was used back in the day, and it was actually a really interesting read. We had clients write into our WhatsApp to say, wow, like, first of all, forgot about this strategy. Definitely could not do this today, but it was really interesting for someone like me to read as well, because it was actually new to me. So if you could explain what this strategy was and why you think this was such a big hit with our clients, our Ohmyhome clients.
Well, to give a little bit of context, the article was how the Sell One HDB Buy Two Condo strategy turned into a debt nightmare, right?
I could have told you that it was
it's a bad thing now, right? So back then, when people were promoting it, when interest rates were really low, right? So borrowing from the bank was pretty much free cash, right? Because it was so cheap.
Wow.
So you could sell a HDB and leverage as much as possible to own one condo for you and your family to stay in, and another condo to rent out.
That's crazy.
Yeah, but people were really maxing out their TDSR, right? So 60%, as much as possible, all in. You know, my cards are on the table. I'm all in, and
Something that Hariz recommends to everybody.
For a period of time, it looked like a sound strategy, because what happened was that you pretty much have your second condo that you rent out pay for itself.
Yes.
Right? So you pretty much get a free house.
Great.
Right? And you are getting a better lifestyle, standard of living, whatever. It comes with, you know, living in condominium. Well, don't exactly agree to that. Sure, some people believe that.
Okay.
So when interest rates are low, that's fine. Today, those guys are screwed. Right? So in this article, I talk about how that increase, that 40% increase of interest rates.
Yeah.
People are now paying 80-90% of their income to pay for these two flats. And even though I'm renting one, you know, somebody could be renting one of those flats, and yes, rent has increased, it's still a negative cash flow asset. It's quite hard for any property in Singapore, even if you rent out from day one, the rent is more than your mortgage. It's very hard for that to do. So it's almost a negative cash flow immediately, right? And so if you're kind of like up to your ears with mortgage payments, what can you do? Some people will be, okay, I'll sell. But if they only bought it 2 years ago, and these are private properties, you have seller stamp duty.
Yes.
Right? So if you sell within the second and third year, you pay 4%. You know, so that's just extra expenses incurred for no reason, right? So again, at one point in time, you know, so it was a smart thing to do, perhaps, when interest rates were cheaper. But it's, you know, these guys are definitely screwed because they probably made some losses right now, sticking to that strategy. So it's always good to know that interest rates will never always be cheap. It's cyclical for a reason, you know. So you can take advantage of it at some time, but you need to make sure that you have some buffer, you have an exit plan, you have a contingency plan if you take such high risk activities or strategies like this when it comes to your house?
Yeah, absolutely. And for our viewers, we'll make sure to put the link of this article in our bio. We can actually talk all day, Hariz, about this.
Sure.
It's actually really interesting speaking to you about CPF. Who knew that CPF could be so interesting?
Yeah, somebody has to do the dirty work when it comes to communicating CPF, right?
No, but I mean, when it's explained to you clearly, it doesn't seem like such a scary thing. So thank you so much, Hariz, for joining us on our podcast today. Once again, for our viewers and listeners, you're listening to Real Estate Real Advice. This is Ohmyhome's very first podcast, and we were talking about affordability and budgeting today. And Hariz has shed so much light on how you can make sure that you're not over leveraged and that you can actually afford your home. Next month, we will have another expert on who would talk about all things property. For those who are not familiar, Ohmyhome is a one-stop shop property solution. Just wanted to remind everybody that we will help you buy, sell, and rent. We have agent services. They actually fall at the top 1% of agents in Singapore, and they only charge 1% commission. Why pay more, right? On top of that, we have technology. We have a whole tech team that developed this app so you can buy, sell, and rent on your own as well. It's a DIY platform, and 70% of the homes that are listed with us were sold over valuation. We also have renovation services to keep your home beautiful, and we're all hands on deck here to sell your home. Thank you, Hariz, for joining us, and we'll see you guys next month on Real Estate Real Advice. Bye.
Bye, guys.